Hartley Rogers joins us now, Chair of Private Equity Group, Hamilton Lane. Thank you so much for joining us. It makes sense. You look at some of the big demands in the marketplace for raising of debt, and the likes of Oracle was one of the first, but others have joined the party over at Alphabet and beyond. Just talk to us about almost a bifurcation that you're seeing in credit markets now, thanks to the story of the deep needs for AI.
Well, I think that the private credit markets are very, very large. Certainly funding the AI build-out is a really interesting part of the market, and it's one of the parts that we like a lot because it falls under the general category of infrastructure. And infrastructure investing, infrastructure lending has been a real growth area with a lot of good potential promise there. So when you look at what private markets firms are doing, which tends to be below the level of the sort of Mag 7 and what they are doing in terms of building out data centers, building out things that access into and out of the data centers, that's been a really critical trend and an enormous spend in the US and around the world.
Let's just get into the sentiment a bit around some of those big spending requirements from the hyperscalers, because the message they've been sending, they're cash cows, very big growth companies for many years. Now we think about a different profile for them, that they're tapping the markets. Some of their loans, I think one was for 100 years, which is not something we'd seen for a long time, since Motorola back in the day. Yeah. So in that situation, is the market going to have digestion issues for some time to come because they just have to get used to these demands? Or is there something in the weeds that people are concerned about at some point? How are we thinking about that sentiment?
I mean, I would separate the hyperscalers, which are very big companies, principally investment grade, going out into the public bond markets, from the real private credit markets, which are funding more the private equity, the smaller companies, the more growthy type stories that lie underneath them. So I think the hyperscaler numbers, they're sort of able to get what they can get depending how the market is. That's almost more similar to the treasury bond market or the gilt market or whatever, rather than looking purely at the private credit market.
Hartley, lovely to meet you. You've said so many things I want to contest, if I may, so let me try and be relatively robust but polite, which is rare for me. If I say to you the words unlit dark fibre, it's enough to send shudders through your industry, I think. Yes, maybe not you, but you talked about the infrastructure side of things, and that seems totally logical. Don't invest in spurious models, invest in the real capacity. I get that. But when I hear the words unlit dark fibre, and it was actually one of the top gentlemen in European tech who mentioned those words to me, he's talking about 25 years ago, yes, when we had the last stunning investment boom, and a lot of that infrastructure was never used. Yeah. What do you think?
I think more of it's used than you would think today. I just think it took a long time to catch up. There was definitely a timing issue, and I think that's a great point, because with AI, nobody knows what the actual rate of adoption is going to be, and nobody knows exactly how this is going to play out in terms of developing the applications that are going to work. So we certainly see a lot of bright spots. It looks to us, if you look at the adoption rate, and we're publishing our annual market overview today, which we're happy about. It's a big deal within Hamilton Lane. And one of the things that we talk about is what's going on in AI relative to, say, the .com time versus the SaaS time, when things from sort of 2010 through the 2010s, 2020, how that was adopted. If you look at the growth rate of AI and revenues from AI, it looks much more like the SaaS adoption than the .com. The .com just kind of never went anywhere. It kind of exploded. It took a long time then for people to figure out how to build models that worked on the internet. A little bit less true with the AI.
Because I remember full well the noughties. I remember the 3G auctions when I was at the Press Association, before I'd even joined Dow, before I joined CNBC. And the operators were arguing with the government, who were operating with the infrastructure providers and the handset makers and the software providers. They were all blaming each other for the slow adoption. But I take your point. You think it's more like SaaS rather than that as well.
Yes.
But you talked about the rate of adoption. And now I'm a big fan of, well, I'm a big fan. I'm very terrified about what AI is going to do, but I think it's going to be pervasive and diffuse and what have you. My problem is not rate of adoption, but rate of route to profitability, to ROI, ROC, ROTE. That is where I have questions, because this isn't just about a couple of big American players. This is where global companies, including the Chinese, including some of those small startups, are really coming up with the goods.
No, I agree. I mean, I think you have to separate the LLM layer, which is very hard to forecast where that's going to go. You have companies like an OpenAI against the Gemini, where Gemini obviously is part of Google that has huge cash flows and can support. OpenAI has had to go out and raise money, the largest ever venture capital fundraise last week, to be able to stay the course and with that. So the question of how OpenAI will make money eventually relative to the competition from someone like a Google is pretty significant. If you look at an Anthropic, that's slightly different because they're focused on a different part of the ecosystem. And so if you talk about people who are doing their own coding and things like that, vibe coding, using Anthropic, there's a lot of that. It's very high potential, and people are getting amazing results out of doing that. So I think the potential profitability in that sort of application layer is really real and interesting. And in our own business, we see it every day.
Yeah, that was a fascinating answer.
Hartley, if people were investing in private credit and they're looking at the funds and they're saying, well, look, when would I get a return on this investment in hyperscalers and big data centers? And then they see the energy price shock and they think, gosh, the cost of running these, the operating costs have just soared before there's even a return in visible on the horizon. What's your assessment of that?
I mean, that's a really good question. I think that comes down to a geopolitical question of how long this is going to last right now. I think if you're looking at oil prices north of $100 a barrel, up 120, 130, lasting for a long time, that is going to have broad ramifications across the economy around the world, in Europe, in Asia, in the US, no matter what, and it's going to impact everything, including the cost of electricity that is going to fund these things. So I think the question of how long this goes on is the material question. Right now, the markets seem to be thinking it's not going to go on that long because the markets have been pretty resilient so far. I think they're looking at the history of the last year in terms of various initiatives that President Trump has done and thinking, well, he's really got to find his way out of this fairly soon. If it doesn't happen and prices stay high, then I think you could have some real issues.
Okay. Hartley, on that point, thank you very much. We will leave it there. Hartley Rogers, Chair of Hamilton Lane, thanks for joining us in the studio.